I have someone who follows trends and believes that trend is always your friend. He's got no emotional attachment when it comes to his stop losses, and that is Atul Suri. He represents Marathon Trends. He joins us live. Atul, good morning. Thank you for joining us. Atul, I'm going to start with some very basic questions today.
Morning to have me.
Do you think this bull market trend is under threat, or this is just a routine correction?
I think it's a correction, Nikunj. If you look at the bull market from 2003 to 2008, we term it as one big bull market, and we've had 3 circuits. So essentially, in a bull market, it does not mean every month is going to be positive. Yes, it is a bit sharp, it's a bit scary, but the fact is that when you get into the contours and what is the reason that's causing this, what is the reason that's leading to this volatility, it's purely news that is better than expected. Interestingly or shockingly, it is better news which is causing this correction. The reason is that US corporate numbers coming out are much better than what people expect. So there is a sense that the US Fed is going to tighten faster than expected. Everyone knew they were going to tighten, but it's going to be faster than expected. And this is leading to this spike in bond yields. Now, that's fine. I mean, just bond yields going up does not mean equity has to crack. But the fact is that there are a lot of esoteric strategies that are linked to these bond yields. You have your VIX trade, you have a lot of ETF money that is really flowing in, and you have a lot of complex strategies that are there in the derivative market. And why I say this is because if you look at the Dow, not just at the end of the day, but look at the intraday chart, you will notice that in the last half an hour or 1 hour, there's always a climatic sell-off or a climatic rise. And that is why you will notice that this is almost a computerized based selling, which has no respect to price. It is just a certain quantity has to be sold, and you find that sort of unwinding happens. So what you are really seeing right now is a certain segment of the market, which I think has been very prominent in the last few years, is your whole algo based trading and all your various complex strategies that there are in the market, and that is reflected in the heightened activity in the last half an hour, 1 hour. So in spite of good news, you'll find markets are cracking. Yes, it's linked to bond yields, but just because bond yields go up or moving towards 3% does not mean it's at the end of equity. So I feel that this is going to be an opportunity in the US, in India, where even in India, I think the numbers are not bad. There are some very good pockets, some very good numbers coming, and these sell-offs or this leverage sell-off is actually what is giving the market an opportunity. So I think it is an unwinding of a leverage trade, a certain segment of the leverage trade which is causing this volatility. That is why I don't think it's a change in trend. You will have a correction. Yes, we are struggling at 10,400. Can we go lower? Yes, we can. Can the US go lower? Yes, we can. But whenever the basing formation happens, I feel that there will be a lot of opportunities in stocks, and this will actually make portfolios healthy for a next uptrend, which I think will come.
So you are of the view that this is just a bull market correction. Yes, a bull market correction could be defined as something very sharp, very nasty, but before you realize the bull market correction has kicked in, it's over. So my next question to you, Atul, is that what is your understanding of the chart of S&P and Dow? Because we've seen a linear uptick there. There is some evidence which suggests that the US profitability is peaking out now. So can we coexist in an environment where the mother market, which is the US market, if that gets into a bear market, what happens then?
So I think that to think that if the US gets into a bear market and you have a 1,000-point fall on the Dow, and you're going to have global markets going up, that's not a case, because US still is the mother market, still the biggest flows emerge from the US. But the thing is that US beyond a point, as I said, that these are certain function of strategies, and they can have sell-off. 23,000 was earlier a base. We revisited it, almost broken down. We can go down, and the US can correct even further. And yes, you will have a knockdown effect, but the level or the quantum of knockdown effect will be lesser. And as I said, 1,000-point days are big days. It cannot be always 1,000-point days. So you will find after a few days that the US may have mild falls, and yet global markets will be higher. So to expect that the bigger that you'll be totally detached, no. If the size of fall is that large, yes, you're going to get affected. But I think beyond a point in time, you will feel that when the ranges get smaller or when markets get into stabilizing mode, qualitatively better countries, better stocks in whichever market you are will show you upticks, they will show you rewards, and these will be the leaders of the next bull market. So I think, Nikunj, at this moment there should be no attempt to just find the base and buy at the base, because I personally don't believe in that. But I believe that this is a great time to analyze and watch. You have to look for companies that are coming out with good numbers but just getting beaten down because of the sentiment. You have to look for stocks which will show you strength the moments the markets stabilize, and these I feel will be the leaders, and these will be the next round of trending. So I feel portfolios will go through a reshuffle. Yes, certain earlier big trends may kind of reverse, but you will also see the emergence of new things, and I'm already seeing it in the market. You can see today, in spite of whatever the market is, there are certain pockets which are holding out. There are some numbers which are very good, and I feel that these opportunities when the market stabilizes.
You do bring up a good point, because there is that nervousness when it comes to the rest of the globe, and as Nikunj was talking about, and as you alluded to, we can't remain completely isolated. The Dow finished with a decline of 1,000 points plus, and that was eclipsed by Monday's 1,175 point cut as well. I recollect as well, if I'm not wrong, that you had spoken about targets of close to 17,000 on the index. What happens really to that? You're alluding to the fact that the undertone of the market does remain positive. So do those targets as well remain unchanged or intact?
Of course. Definitely those targets remain intact, and I can thump the table and say that, because just reacting to every small move or everything is never going to make you ride big trends. In a ride of a big trend, not every day, not every month, not every week is going to be positive. You are going to have negative months, but the fact is your ability to ride them and be able to reallocate your portfolio and have the next round of winners is crucial. So I think that these are opportunities that will come. Yes, it is painful. Yes, it's not pretty. But the fact is that, having been so many years in the market, I don't think anyone, you would be really, smoking something else to realize that this low volatility and this dream scenario would go. If winter comes, spring is not far behind. If spring comes, winter is not far behind. The greatest trend of 2017 was low volatility, and look what is happening. We are having a heightened volatility situation. So this is a cyclical nature of markets, but the important thing is to ride the bigger trend, and each volatile move throws up fresh opportunities. The important thing is to not lose your nerve, to have confidence, and I still think that not trying to find the bottom, because nobody knows where the bottom is. Let the market stabilize, let it settle, and you will see pockets of strength, and then it is our job to just get into them, because these are going to be the leaders of the next trend.
I'm going ahead and tweeting that, Atul, that you're saying that the target of 17,000 remains intact despite the kind of corrections or speed bumps on the way as well. So conviction clearly remains. That's what I'm gauging. But I want to talk about, if you can give us a sense of a correlation between what's going on with the bond yields. The 10-year treasuries in the US are nearing 4-year highs. Back home as well, the 10-year GSEC has remained at fairly elevated levels. Any sort of a correlation as to what this might do to emerging markets like ours, or the rest of the globe, and how one should really read into what's going on with bond markets?
Yes, definitely it is a cause of worry. The cost of capital goes up, the flow, the easy money reduces, so that does lead to a crunching down. But that does not mean that if bond yields go up to 3% or beyond 3%, nobody is going to invest in equity. Equity as an asset class is dead and all money is going to move out. It is just that every strategy has a certain cost of capital. Even a guy who buys delivery based from his pocket has a certain cost of capital, though it's notional. And here we are talking about a very, very highly leveraged market. Your inverse VIX and things like that are extremely leveraged markets. And for them, a 10, 20, 30 basis point move makes a lot of difference. So what I feel is it's that segment of the market that is getting sort of re-rated, or that's where you're seeing readjustments happening. And that is what is causing liquidity issues. And that is what is causing this kind of volatility. So if bond yields go to 3%, that does not mean equity as an asset class is dead. That does not mean that corporate earnings are going to nosedive. No, the fact is that the trend remains still up. Yes, you are having adjustments. Yes, you are having volatility. A certain category and class of trade is getting affected, and that you can see purely if you look at intraday movements in the US. You will see the kind of moves that are happening are climatic toward the last half an hour, 1 hour, and this is nothing but computer-based selling, which is readjusting strategies based on which is the primary thing, which is bond yields. So what you're really seeing is these kind of adjustments, but it is not the end of the world. Yes, the quantum of free flow of money will change, but it's not the end of equity. There will be people investing, and I feel that these are opportunities. I mean, in India, we get even further dealing because you have your domestic money. You have an FIS selling all of 2017, and you still had a bull market. So the thing is that, well, if they may continue, and if Indian investors, you'll be shocked the kind of maturity, I mean, I interact with a lot of them, is the kind of maturity you're seeing with them, the kind of lack of panic. In the last few days, we've had a market that's been volatile, and I'm seeing record inflows. I'm seeing a lot of people calling up who are waiting the sidelines, waiting to invest or deploy money, are calling up and saying that let's get in. The kind of flows that I've seen in the last 3 to 4 days, and that is very different, having been in the markets for 25 years, how I've seen Indian investors behave. So I think that Indian investors, I mean, unless you have a massive lag effect, you have a 1 to 2 year kind of underperformance, but I don't think the Indian investors are going to go through or go out of equity so soon. I think they're long more committed, and if this equation remains, it will offset the FIS selling, which may be, as I said, a function of a lot of cost of capital and things like that, which are extremely complex for us to know. But I still feel that you see a massive shift in the psyche of Indian investors. In fact, the flows that will come or that are coming in these times, I mean, there's lack of panic. When I speak to people and all, earlier the people used to be like, oh, what should we do? Should we redeem? Should we sell? Should we this? Blah, blah, blah. No, wait and watch. In fact, now they're speaking with the checkbook. And that, I think, is a very, very different mindset or a different approach I'm seeing. Yes, it cannot go on forever, but fingers crossed, and we are optimistic about that.
Triumph of an optimistic, and I think, Atul, one of the big reasons why equities, in a sense, are not really and discarded asset classes because alternates are not doing well. Money in fixed deposit, money in real estate is just not going anywhere. So lack of options, of course, is one of the factors why equities is doing well. But that is not my question to you, Atul. My question to you is that you are a trend follower and you have no emotional cord with the market when it comes to buying stocks or selling stocks. So where do you think the trend is intact and this will just be a shakeout? Because the trend in NBFCs is now shaking. The trend in metals is now shaking. So as a trend follower, what would you do?
Look at IT. You find amazing trend. You kind of see autos. There are some very interesting in the auto ancillary space things happening. So I feel that there are a lot of pockets that there are where the trends were actually never there, and you just had pop-up rallies or catch-up or PSU banks. You had this very big thing in real estate. Pharma is going to take a lot more time and have a bigger basing formation. You have a couple of pharma stocks that are taking off based on their numbers, etc. But I think pharma is going to take a lot of time. So there you never really had trends. You had a basic catch-up which was happening towards the fag end of any bull market. But I think the larger term trends that are there are still intact. Private sector banks, I mean, the trend is still intact, and I think that is a great space. So I feel that there will always be pockets. Some will get questioned. As I said, portfolios will go through churns. Certain sectors will fall out of favor, but a lot more will emerge. And I guess that's what's my job, to really keep in sync with the trend, because outperformers in falling markets are leaders of the next bull market, and that's my base belief in what I do.
Has your portfolio composition changed? Now you're managing public money. I mean, you are the only guy I know of who's running a portfolio management service based on technicals. Others are running it on fundamentals. So what was the face of your portfolio on 31st of December 2017, and after this show called wrinkle, shakeout, crash, whatever may be the word, how exactly have your top 3 or 4 positions and trades changed?
So essentially what has really happened, Nikunj, is that certain NBFCs or housing finance stocks found themselves being eliminated, and we think that there's been a bit of a longer term trend change there. But what has emerged as replacement are a lot of places in the specialty chemical space, which I think is very, very interesting. I feel that there are some other stocks within the auto ancillary space that have emerged. So I feel that this sort of underperformance, outperformance will continue, and it's for me to ultimately to keep aligning myself And as I said, that we also look at fundamentals, and you will notice that this is being supplemented with the kind of numbers that are coming. So we look at numbers, we look at the bigger picture in terms of performance, and then we combine it with technicals and long-term trends, and that's how we approach portfolios. So there has been a bit of shuffle, but more out of housing finance companies and some NBFCs, and more into specialty chemicals and auto ancillaries.
What's the sense that you're getting in terms of the overall general trend? I've understood what you've said about the markets and how we have moved pretty much in tandem with what the global markets have done. But what do you think is going to lead to a trend change movement where you would perhaps say, now I may revisit my call or my bullish stance on the frontline index?
I think a Nifty below 10,000 would get me to revisit my thesis, relook. As I said, recalibrate, especially my sense of time or how much time horizon it will take. But I think till then I would sort of hold my horses.
Is what you're talking about in terms of levels. And what's your view on the Nifty Bank? Give us a sense as to how you've seen that index, because it's been awfully volatile. I mean, right now we're clutching onto the 25,500 mark. What are you looking at, or any sort of projections? Have you done them?
So I find that the Nifty Bank actually is a two-animal index. You have your PSU banks and private sector banks, and if you somehow dissociate and are able to look at them separately, you'll find that there are still the private sector banks, the few leaders that there are three names that come to mind, which we have in our portfolio. Still, I think the trend is intact. There was a spike in PSU banks. I disbelieve that spike or that spurt, and I don't think there was a trend there. There was just a dead cat bounce, and that is being reflected in prices. So yes, you can remove levels in Bank Nifty if you're trading the Bank Nifty, but I don't trade indexes. So for me, essentially the Bank Nifty is all about a few private sector banks, and that's where I think the trend is still intact.
Closing comments, and we've had a very interesting chat as to why the bull market is intact, and it's good to hear that you've started looking at them fundamentally as well. Do you think there is money which is going to be, or serious money is going to be made this year by going short as well?
I think so. You'll have to be sharp. You'll have to be very good. Shorting the market is a very, very highly skilled space to be in. It requires immense amount of speed. So I think that people will make money on the short side in certain pockets. We are not going to have that kind of dream slumber run that we had last year. So that itself is where the opportunities are. But the fact is that I have always seen that a lot more money is made on the long side. A lot more money is made in the longer term. Because the whole power of compounding sets in, and that's where your conviction gets tested. And this is where we are right now, where our conviction is getting tested. But I still remain optimistic, and I still believe that it is a long-term trend which sets in the power of compounding, and that's how wealth is created. That's how I've seen it in my life. For most people whom I've studied, admire, and adore.
Lovely chatting with you, Atul. Lots of takeaways. No dream slumber run. The undertone of the market does remain positive, and you're holding a conviction call that we could see that 17,000 mark as well on the Nifty, despite the kind of correction we're witnessing. Great chatting with you. Thanks so much for joining in.